Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. So this week we have a lot of economic data that is coming out. We're going, well, I shouldn't say economic data overall. We did have payrolls. They were adjusted. The marketplace was anticipating that. Market was very muted. They adjusted them down by 818,000, which was a very big number, but the market didn't really react. We got basically flat markets going across the board. Everybody's waiting on the Fed minutes, which will be out tonight. But more importantly, Jay Powell, the chairman of the Fed, will be talking tomorrow. And I think the biggest thing to try to discern from the conversation is, we're most likely going, according to the futures, we're definitely going to have a rate cut in September. There's a 34% chance, based off of the futures in the Fed Watch tool, that there will be a 50% or a 50 basis point rate cut. And for sure, there's at least a 25 basis point. And if they only go 25, what a lot of people will try to see if how many more rate cuts are on the table going into the end of the year and at the beginning of next year. Some people are calling for up to 150 basis points, more likely maybe 75 basis points, but job growth is weakening, and that is a concern of the marketplace. Everybody is really, I think, we got September and October, which now that I've gone down that road, I've talked a lot of time about seasonality. And I would usually say that if somebody mentions seasonality, it usually means they're wrong on their forecast. And that's just a bailout of a lot of the pundits on the major shows trying to explain why their forecast was incorrect. But I do feel like the true September and October, year in and year out, those months underperform. Now, in the long haul, the markets in September and October are basically flat, but we did have the big downturn last year, and we're heading into this election. And I think the marketplace, surprised to see the VIX as low as it is right now. And we actually took advantage of that on Options Guide TV. Once we saw the big spike up in the VIX, we did quite a few we did two, not quite a few, I should say. We did two butterflies that were bearish on the downside and took advantage of a down marketplace. As a matter of fact, I still have one in my account, in my actual trading account, that is going to expire this Friday. And that's going to be a profitable trade because we were bearish. And the VIX index ran up, it hung around 30 for a long time, and then it has finally now broke down below 20. Okay. So surprised to see the VIX at those levels. I have a special guest. Basically, I think I would call it the Bible of the VIX index. Not many people have written about the VIX as much as my guest this Monday. His name is Russell Rhodes. And he was on the show about this time last year. And we're going to talk about the seasonality of the VIX, and we're going to look at some of his favorite trades in the VIX index. And we're going to put on a few live trades that are going to look for an increase in volatility going into September and October. So I don't mind that the VIX is down at this level. I do expect volatility, especially going into the election. And until that known event is done, until that weight is off the marketplace, I think the market is going to struggle to go higher. And a little bit of the seasonality. For some reason, people just want to sell stocks in September and October. It seems like one little news item, and all of a sudden the market turns bearish for the short term. And so I'm excited about Monday's show to be able to talk to Russell and have his ideas on what's going on in the marketplace. All right, so 1 second here. Let me get my screen set up, and then let's look at the Lowe's trade. So we're going to run over to the TradeHawk software here in just or I'm sorry, the Tradier Pro. I still every once in a while make that little flub, now called the Tradier Pro. So let's let's bring that up. Here we go. Okay. Excuse me. Let's do a quick little. Let's go. So Lowe's, well, retail has really been mixed. A lot of the department store chains got beat up, Macy's, Dillard's, and it's earnings season for them. And also saw Walmart do very well. Target had a great earnings report. Even stores like Gap, the apparel department stores, are doing fairly well. Gap had a good earnings. So we got half of the retailers doing well this earnings season, and almost right down the middle, the other half is not doing as well. So Lowe's came out, and if you were looking at the chart on Lowe's, you wouldn't even know that they announced earnings. The stock really didn't do much on Tuesday after their earnings report. We had a bullish trade on, and we got less volatility than anticipated. There was an opportunity to get out at a fairly decent gain to the account. And if I'm putting on an earnings trade, and especially like in a butterfly, and I get anywhere close to my short strike, I'm going to take that trade off. And usually it's going to be the day after earnings. Now, I've talked many times about the dynamics and the Greeks of the options marketplace around an earnings report where you are announcing on a Tuesday, like Lowe's did in this instance, versus a Thursday, which Amazon usually announces on a Thursday, mainly because you're going to be using that Friday expiration, most likely to trade the options if you're just going to trade that earnings report. And having only one day for the option contract to live is much different than having an entire week. And this is going to play out here in this scenario with Lowe's. We're going to review this trade. We're going to look into it. So in this instance, we're showing Lowe's. Well, let me pull up the chart real quick. So like I said, it's very uneventful. So this is an 800-day chart. I'm going to zoom in on the market here. Let's go from the highest point down to the lowest point, and then let's move this a little bit. Okay, so on the 20th is when they announced earnings, and you see this candle, almost everything kind of hung out right in this range, basically opened and closed at almost the same point, but it did run up. So the high end of the candle was 245.55. If we look at our trade that we have on, I still have it down here in the trade box, so focus your attention to the bottom of the screen. We'll see that the Friday expiration is the 23rd. We bought the 245 strike, sold the 250, and didn't buy the 255 because that would have been a standard. So this is a truly modified butterfly, and we did it for a net debit of $1.04 to the account. So if you were quick-handed, because we didn't really hang around that long, I don't know if I would have expected you to get out at that level, right? Because you're getting right to the short strike. If we would have got closer to the 250 level, that might have been true. And it came back down. So now here's the way I'm looking at those. So far, retail sales are good. Yeah, well, we see we're up 0.5% today on the market. We're at 241.72. So there is an adjustment that we can do on this trade because we are close to where the market is at. I'm not saying I would do that adjustment. You can take this trade off right now and lose about 40 some cents. You're losing almost 50% of what you paid, right? So that makes sense. If you're in the trade, you hung around, it ran up, it bumped up against our long strike, but it didn't continue on up. It didn't hang there very long. You have an opportunity to get out and lose about half of your investment on an earnings trade. Not bad, not bad. Okay. Now, if you want to on this trade, you can go out and actually sell this scenario here and make a little and get yourself set up so that you have a little bit more upside on this trade. So if we go in and do the trade where we flip the script here, we're going to sell the 245 strike, bring in some profit on that trade, and then be one standard deviation away, and we're going to roll into a 2.5 point short spread. Okay, hang with me here. That would be the adjustment. We would totally flip the script on if we're bullish on the trade, and we're going to end up with two short spreads that want the market to go down. I didn't anticipate that Lowe's was going to go nowhere after earnings, basically open and close right where it's at. So I didn't even talk about an adjustment, because very rarely do you do an earnings trade and you can adjust that trade. We are going to be able to do that because the market didn't move very much, and they announced on a Tuesday, and we got Wednesday, Thursday, Friday, 3 days to trade. This trade would have been completely done if they would have announced on a Thursday and you just had 1 day to trade. This is the huge difference, and part of the reason why I pick the strategies that I do when we do them around earnings, because we learn so much about earnings. It's not like I sit around and just trade earnings all day long, but we do Options Guide TV 3 days of the week, and we're always looking for new trades, and you learn so much by trading around earnings. You just learn how option pricing really works. So if you have any questions in this, load up that chat box. If you're in the Tradier YouTube channel and you're logged into your YouTube sign-in, you can ask questions there. If you're in the Tradier Hub, which is the preferred location to actually watch the show, and you log in and you set up a sign up there, you can also ask questions inside the Tradier Hub, or you might be watching it live streaming on my X at brianoverby.com. But load up those questions. So here we go. This is going to be kind of a fun adjustment. So here's our trade. The market is at 241.84. We could get out and we could do okay. We'd lose half the value of our trade. Really not a bad alternative. I'm not thinking that Lowe's is going to get much above 245. We've had some decent earnings, so it's possible, but everything's possible, right? It's the marketplace. We're going to sell this option contract and then use the proceeds to buy this option contract. So the way that it happens, I am going to, this is your position. Remember, this is the position we have on, but I'm going to remove this leg. Boom, that's gone. This is no longer going to become a buy. It's going to become a sell to close. So we have buy to open down here. I'm going to hit sell to open because paper trading account, I don't have it on. But this would be a sell to close of the 245 strike. And guess what? We're going to buy an additional 250. We can bring in $1. Totally flip the script, right? We want the market to stay where it's at or stay below our middle strike, which in this instance was the 250 strike, which is more than one standard deviation away. I mean, the delta on the 250 strike is $10. So low probability that it's going to get to that strike. This actually isn't a bad adjustment whatsoever. And I'm kind of glad that we have this opportunity to talk about it. You don't learn as much on trades that always make money, which we've had quite a few of recently here on Options Guide TV. So here's the way it goes. Let's do the read back. Okay, I got it here. What we'd be doing is, based off of the position in our account, which was our modified butterfly, we are going to sell to close the 245 strike call. It won't let me put close in here, but we're going to sell that 245 strike call with the August 23rd, this Friday's expiration. And at the same time, buy to open the August 23rd, 250 strike call. And we're going to do this for a net credit. 97 was great, but it's already moved against us. 92 cents on the account. We paid 104 for the trade. We will then be down 12 cents total on the trade, but we still have risk. We've increased our risk because we're now going to be our final position is going to be short 2 of the 250s and 2 of the 250 250s, which means that you have $500 in requirements, and that will be our trade when it's all said and done. So let's set up this position and adjust it in the what if calculator. Okay, so let's turn this back to, let's just close it out. So our final, I'll just put the final position in because I'm going to get convoluted inside the what if calculator if I try to manipulate all this on the fly. So our final position on this trade would be short 2 of these and long 2 of these. And we're going to send this to the what if calculator. And the market is here at 241. Let's pull it down. So the market is here at 241. And we would end up in the short spread. We'd have $5 of risk total. And really all we're doing here is we're selling the one option contract that has some life in it. And we're buying the cheapest option contract of the 3 in our position. So the fact that the market didn't move at all really gave us an opportunity here to adjust this trade. And I didn't anticipate that would happen. This is why it's important to have these strategies in your back pocket. I really didn't see this until I set up the trade to talk about it. And all I was going to talk about doing is actually just getting out of the trade at a 60-cent net credit to the account, losing basically half of the trade and feeling like you got lucky in that you did an earnings trade and the market didn't do what you wanted and you actually salvaged half of your net debit that you paid for it. But if you got any comments, I mean, I'll give myself a thumbs up on this trade. This is a creative way to try to reduce your risk. Now, you're looking at a 1 standard deviation move. The market didn't even move this around earnings, but you're talking your risk now is what we'll call this 242, 8 points before it gets to your short strike. But if it gets to your short strike, you want to get out of the trade. 250 would be where I would just, if the market got there, I would just close this out. Gamma is going to be very big with the way the market is going. And in the last few days to expiration, it can move against you hard. You could end up losing the $500 because remember, you're short 2 of these spreads at $2.50 each. And Gamma will make Delta very explosive. And if it gets in the money with just a day or 2 remaining, you're going to pay in a hurry. That's simple. All right. So let's look at another trade. That would have been really fun if we could have got out at even. I don't want the cheese anymore. Just let me out of the trap. But I'm very happy that that roll was at least 92 cents. It was 97 cents when we first looked at it, but 92 cents. So fairly close to salvaging a potential, well, turning a losing trade into very close to a winning trade. All right. So SPX. Okay, so I'm glad we changed up our mind. I was looking at doing Iron Condor. I struggle with the way the markets are to do an Iron Condor. I do think that the markets are going to stay fairly flat. But if you look at the SPX, we have been fairly strong since Monday. When we put on our SPX trade on Monday, which is our trade for the week. And I even mentioned that I'm really just kind of waiting around because I want to put some trades on with Russell and the VIX index, hoping the VIX kind of stays right where it's at right now. Where do we see it at? 16. We did get a little bit of a jump. And maybe it's because of the Fed. I loved it right around 15 in that scenario. And so the SPX here, 1 second, let me pull it up. 550. Oh, I got it written right here. 557.60 and oh no, I'm sorry, 55.75. I don't know what I'm talking about. All right, sorry, I got a message and it distracted me. SPX 56.12. Okay, we went and we looked at the August 23rd expiration. Let's remove this trade. And in this one, we want to take some profits because August 23rd, 2 days remaining to expiration. We put this on Monday. The market was right around 55.60, and we did 15 points wide. So we bought the it was actually 55.75. So we bought this one and we sold this one. Now, we didn't sell two of them, we sold one. So 15 points wide, we did it for $9. We now see that this is trading for $11.35. We could take the trade off. The maximum that the trade can be worth is $15. If I have this trade on, I'm probably going to leave this. I like the way the market is going today. I guess it was taken as positive news that the jobs were down 818,000. So you might read it as positive. Tomorrow is the Fed speak. Yeah, I think I would ride this one overnight. I don't like that the VIX jumped up. And so we got the VIX up in an up market. And that does make me nervous, but that's just one data point. But I would work this to the end of the day and then maybe take this off. I would put this in at a limit to close this at, let's say, 1250. And that would be my trade. So you would flip the script on this. This would be sell to close. And this would be buy to close. And I got to hit open here. And we would say $12.50. And if I could get that today, I would take it. And if not, I might close it out at the end of the market. I don't like that the VIX is up, even though it's a little amount, but it's still showing some nervousness in the marketplace. And it probably has something to do with the Fed meeting. All right. And SPX is up. So very simple, very straightforward trades. Don't want to put a new trade on. Did very well. Well, if you would have got out on the Lowe's trade the day after earnings, you probably could have been profitable on it. I don't mind the adjustment turned out pretty cool that we were able to talk about the adjustment because Lowe's just stayed where it was at after announced earnings. On this trade, we are up, but we don't, it's got to stay above 55.75. So let me take this back and I'll just show you the trade. So instead of doing a butterfly or anything, we decided to be neutral to bullish. And that's my outlook here because we sold the most at the money option contract. The SPX was at exactly 55.75 when I took my screenshot on Monday. So we sold that option contract and then we bought a deeper in the money option contract. It's amazing how much time premium is still in here. And in order to get the maximum of this trade, what has to happen is this extrinsic value column, this value needs to go down quite a bit. We need this to start withering away in order to make that trade profitable. And that's what I want to show you, that if we send this to the what if calculator, even as of today, got a good profit in it, up $1.20 on the trade. But right now you're seeing the profit and loss graph as of today, which is the green line, is quite a ways away from where the max profit is at. And that's because this option contract that we sold, we got to buy back. And it's extremely expensive at this point in time to buy it back. So a couple of days of time decay. Actually, today, Wednesday, is a very big day of time decay. Then obviously Thursday to Friday is another big one. I got a cough, so give me a second. No questions? We're almost at time, 11:24 a.m. Thank you for stopping in. Very interesting Options Guide TV today. And we'll come back Friday. And I'm not quite sure what I'm going to do on Friday at this point in time, but very excited about Russell Rhodes on Monday. And I do want to place some of those trades. We're going to place some trades on Monday in the VIX. Maybe we'll do one on Friday. If we get the VIX to come a little bit back down again, I do want to be long VIX options in some way, shape, or form going into September. So maybe we'll set up Friday and think about what we're going to do in the VIX when Russell, very excited, good friend of mine, comes in on Monday and we talk about the seasonality of the VIX. Thanks for stopping in. My name is Brian Overby, the author of the Options Playbook, and we'll see you this Friday at 11 a.m. Eastern Time for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.